Good morning. Welcome to QuantBox Live. I suppose I should bring up the website. That's part of the routine. It's about 6:35 in the morning, approximately 3 hours before trading starts on Wall Street. Welcome to QuantBox Live, where we get our AI-driven macro analytics. Yeah, it does a ton of work for you. It's like hiring a quant and making them work in a box. I don't know. It's like hiring a quant, except guess what? It doesn't cost you $25,000 a month. It won't cost you $24,000 a month. Won't cost you 23 or 22, not even $20,000 a month. Yeah, and you don't need a coupon code. All right. So, anyways, look, it does a lot of work and it automates all the research for you so that you can make intelligent, informed decisions about your trading and investing. My name is Wayne McDonald. I'm the founder, and also have an economics degree from Harvard. And I built this because I'm selfish. I want, I want all this information. I want it done automatically. But here's the cool thing. Yeah, I share it with you so that you can also trade like a hedge fund and not like a retail amateur that's just trading by gut instinct. Like, for example, when you look at the Commitment of Traders report, it helps you organize your information about actual cash flow in the market. What are the big institutional investors doing? See, we know this because it's required by law to report those positions because they're so big. Well, how could you possibly trade not knowing where the big boys are putting their big money? Anyways, swing on by quantbox.co, $8 trial. After that, it's $80 a month. All the dollar pairs, all the yen pairs, gold, oil, S&P 500. But it's actually a way, way, way better deal to go pro. You see all these extra benefits. There's, I don't know, 6 or 7 or 8 more benefits, huge ones that I've added to this list, but didn't put on the list. Right? For example, one of the things not on that list that's in the pro account, is a central banking tab that will show you interest rates and inflation for every major economy in the world 18 months into the future. Does QuantBox guess to get this information? Does it make an opinion? No, we gather it from the OECD, and the OECD gathers it from all the different central banks. It's the central banks telling us the future. And QuantBox has that and displayed beautifully. Anyways, take the trial. If you're watching this on YouTube, your video is delayed many, 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 many hours. But let's move on. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So it looks like I actually have to log in. Coolio. Let's go into the pro. Let's go into the, all right. So we're here. Yields now back down. Very nice. Okay, that's nice. Remember, we were 4.8. So now we're down to 4.6. At some point, it either hit 4.55 or I was projecting 4.55. I can't remember now. But nonetheless, down is good because that means up. Wait, what? Yeah, if bond yields are falling, then somebody are buying those bonds. So they're actually treasuries. Okay. So they're buying treasuries. Somebody is buying treasuries, lowering the yield. Now they're not buying it out of well, they might be. I don't know their intention, but this move down on treasury yields coincided directly with last Saturday's attack by Hamas on Israel. And that's typically what happens during a time of fear is money flows to safety. And that's definitely safety. The 10 years is safety. But there's also this other narrative that the Fed is done raising interest rates. And therefore, that would be the peak in the yield. If the Fed keeps interest rates the same for a year and then starts cutting, then if you're in this investment for 10 years, then for 1 year, rates are flat and the rest, the rates are down. What that means is the value of your investment goes up. So I'm worried about the narrative of fear driving this, but I do hope that part of this is peak interest rates, and this is the best deal you can get. Because remember, you buy these bonds at a price, so this will be the cheapest you can buy a 10-year Treasury probably forever. Is one idea. Oil, okay. Well, it's already high. Big move on Friday. Gold is down a bit. S&P 500 down a bit, expect to go up today. Remember, now we're in earnings season for sure. So this is a bigger week, I believe, than last week. And then next week is a huge week. So earnings are coming in. And so far, yeah, everything okay. Euro dollar stable, Bitcoin up. That's a risk on play. This is a risk on. So the 10-year is a risk on, Bitcoin is a risk on. And now for that narrative to continue, we would want gold up. Taking a look at the risk gauges. Okay, there was a slight tweak towards bullishness, and now it's kind of gone back. So we went from +1 to 0, 0 to -1. But this is now slightly risk on. So we'll see how I mean, obviously, it's early in the week. 6:30 in the morning on Monday seems early in the week, although 12 hours ago we were already trading. So, anyways. Here he is, and we'll see if it rolls toward risk on or if it rolls toward risk off. Okay, a ground war, you know, in Gaza would be bad. So we'll see. Okay, volatility month over month for VIX is still quite high. Remember, this is rolling 30 days, and you want risk down you want VIX down for risk on. Okay. S&P 500 is giving some back. Okay. Yields on a rolling 30-day basis are still showing a big up move, which is very bad. But on a weekly basis, they have come down. So that's good. So this is the turmoil we're in. Okay. Longer term, bad. Shorter term, medium. Okay. Here's the COT data. Okay. The most new bullish contracts go into NASDAQ. New money. This is hot money, guys. And now NASDAQ is slightly bullish again. Okay. Or remains slightly bullish. But that's the biggest move into bulls. The biggest move out of bulls is actually oil. Hey, no, that's interesting, huh? Well, that's fear. Remember, a couple of weeks ago it was straight down. We have probably a new narrative now, and remember, this is from Tuesday of last week. Okay, so I don't know if it reflects the new reality. Okay, but nonetheless, that did happen, and the oil markets did fall. Anyways, we'll see. On the flip side of all of this, oh, and one thing I should note, it's still incredibly bullish. Okay. So it's not like it's negative. There's just that particular period. Money did come out. Maybe it was profit taking, but we'll see. Anyways, oops, I'm doing the wrong one. That would help. Okay, let's go there. Oh, I have to reset this? Boo, I clicked the wrong thing. Let me reset it. All right, let's do it this way. The biggest change in bearish, right? There are more bears than there were before for gold. Hmm. Once again, I'm not sure if it reflects this data, but it really should. I mean, that's interesting to me. More bears in that situation. So again, this is Tuesday of last week. So it does include war tensions and geopolitical risk. The interesting thing is that is the number. I mean, it's not debatable, but it's the wrong move by institutions. Interesting, in my opinion, because I was clear Sunday night in the day trading group and then Monday morning here. I was clear. I'm like, you buy gold, you buy oil, and you buy the dollar. I'm like, that's it. Or Swiss franc too, right? Swiss franc. I said, be careful with the dollar because I want that to be weakened. So focus on the Swiss franc. But anyway, so these guys went against that, and I disagree with it, but that is the fact. And we lost a lot of bears on the 10-year, right? On the 10-year treasury. Still heavily short, but probably changing. And that's what we want to watch. Okay. Because in this case, we're not talking yield, we're talking about price. This is the actual futures contract. So what does that mean? That means yields should now come down. Oh, and what it's showing is money is moving in. Well, in this case, actually, money didn't move in, but obviously an inflection point. This data is basically capturing, let's just call it the Monday as the world found out that there could be a war in the Middle East. And so it seems to me they reacted not consistently, but there was some reaction. But what I would have expected is this would have been a plus 11,000 and this would be a negative, right? Money going from the short to the long. But nonetheless, maybe they got out of this treasury and bought something else. Right. Maybe NASDAQ? I don't know. It wouldn't have been my first move, although I'm exposed to NASDAQ. So what can I say? Anywho, so this is the commitment of traders report. Oil's still very bullish and yen is still very bearish. Okay. Aussie is nasty. Aussie, CAD, okay, are really, really, really hurting. Okay. The red line is actually the US dollar. Okay. And the green line is the Aussie dollar. When you look at the differential, these bars show that you would expect to be bearish. And the red line is the actual price. So notice the divergence here in this area. And that's okay. That's seen as here. And down, down, down comes price. So QuantBox looking at this institutional data is telling you, yeah, bearish. The nice thing about this is it can remove your opinion or your guesswork. You can use this as a crutch, so to speak. When somebody says, why are you bearish on Aussie dollar? Oh, I'm following institutional investors. Okay. They're heavily long dollar and not so much on the Aussie. Okay. It's kind of an interesting process, isn't it? To do your research that way. You're like, I don't know anything, but I think the hedge funds might. And here's a bear versus bear. This is why if you trade Aussie yen, you might get inconsistent results. Nobody's long either of these. Okay. Things changed around June. Okay. Look at this, the peak. Okay. June 25th. The next week was Canada Day. That was the peak for that asset. Huh? Canada Day. Telling you. That's where the Canadians take out all the ships in their navy and they put it on display, the power of the Canadian Navy. Um, yeah, the three boats. Beautiful, beautiful. Yeah. All right. Yeah. Why don't we look at the swing trade heat map? Proceed. Okay. Oil's still the biggest mover, followed by gold. Okay. We are now 1 week into geopolitical tensions. And the first opportunity we had to meet, that was the day trading group. I said, be prepared for oil to go up and gold to go up. And then pay attention to the Swiss franc appreciating as well, as money flows out of the region of tensions and into safety. So on the downside here, Kiwi Swissy down, Aussie Swissy down, Pound Swissy down, Euro Swissy down. Okay, cool. And I said stay away from USD Swissy, and sure enough, basically neutral for the week. This is what these assets did over an entire week. So my point here is not to say, ha 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 ha, I told you I was right. Um, I asked people, and this is the day trading group, so it probably wasn't here, but many of you are both subscribers. So I asked you to write these things down. This advice I was giving you, write it down as contingency plans for all situations in which there's geopolitical risk or war, so that you know exactly what to do when this happens. And so that was me predicting the war or predicting the future from a Starbucks, I'll remind you, that oil and gold is likely to go up, and so is Swiss franc. And so a week later, true, true, and true. Okay. Yeah. Now, the weird part of this is I also bought the S&P 500. And I'm like, that was a hedge against my hedge. And it also went up barely, but uh, I was actually a little bit surprised by that. But I said my strategy I've been waiting for 3 or 4 or 5 months to trade was be long S&P 500, so I can't abandon it. So stuck with it, and that's doing fine. Interesting. Let's just kind of zoom in. Let's kind of look around a little bit. Okay. So currently, when you look at the economics comparing these two economies, it's very bearish. Best case scenario is we're on our way to 104. See, 105.33, 104.89, 104.45, even further out, 103.81. Interesting. Okay. But look at this. Institutional investors are long both. Doesn't make much sense. Choppiness. Retail is heavily long, but institutions not. There's no direction institutionally, which means even though it's very, very bearish, it's interesting if you look at seasonality. Seasonality says right around now you get up, despite the economic situation. See, the blue line is 20 to 30 years of data. Think of all the periods in which there was like Brexit and there was Grexit, right? The Greek financial crisis, and all kinds of things going on in Europe. And it's all incorporated in there. Even in those situations, that's all put into these averages. Still goes up. So we have geopolitical risk and all that kind of stuff. Yep, yep, yep. And economically speaking, this is very bearish. Remember, QuantBox is a machine. And it's just telling you what is. This is. This is all factual. This is GDP. This is inflation and their differentials. This is employment, right? This is, if you took a snapshot, this is what you would think. It's like accounting. It's a balance sheet. It's not an opinion. There's no variable. It is. That's the number. That's the balance sheet. That's the snapshot today. Then our job, and we use QuantBox for this too, but our job as investors and traders is to take this snapshot to understand where we are on the map of things. And the next step is then more a matter of finance, which is the flow of capital over time, cash flow. And so here's the average flow for euro dollar is euro dollar on average goes up. That's part of our now analysis of what we think will happen moving forward. We could say to ourselves, things look really bad, but for some reason, up might be a potential until about January, and then January it peaks out and comes back around. Okay. All right. Okay. Burned. Yeah. I used to tell people that burned. It stopped impressing people. Burn's like, I thought I thought you drew these by hand. Yeah. Yeah. So, anyways, kind of interesting. Why don't we look at you guys trade the DAX? Okay. Mixed bag in the German stock market here. Retail's 50-50. Okay. And here's the seasonality. And DAX is down, and QuantBox projects it down. Now, it's QuantBox, when it's doing technical analysis, is only doing technical analysis. Okay. It's not looking at seasonality, so we have to look at both. Which one's right? They're both right. So this is where QuantBox is doing, it's calculating a mean, not this average, but a slope. So you get the mean and then the slope of the mean, and then you calculate the variance, and then you calculate the standard deviation, and then you go back to the mean because you know the slope, and therefore you can then project based on the slope of the mean. Okay. And the above and below is the standard deviation for worst case, base case, best case. That's okay. So it's just looking at the technicals. And the technicals say down, but the fundamentals, if you will, when you lean on seasonality, is like down is normal, but in this time of year, it tends to turn around and head back up. So if it does, it's not that it will, because remember the analogy for average. You got 1 foot in a bucket of ice, and 1 foot in boiling water. So everything's normal. Mm-mm. Unless you switch your feet back and forth quite a bit. Uh, I guess we can call that volatility. so, so anyways, so just be prepared. Okay. If you look here, there's a lot of pressure to the up, but it's not happening. Okay. Oh, yeah. Browser lag there. Let me move. Okay. Has been bearish. Okay. Wondering if there's a turn. So this is the same seasonality, just displayed instead of lines, bars. The bottom of the S&P 500 in this period of time, meaning let's say the fourth quarter, it bottoms out in September, okay, and then heads up in October and then way up in November. Okay, so that's the idea that this should be turning up, and it seems to have done it. So again, bottoms out somewhere in September, and then by October is up. Well, the bottom right now is the 3rd of October in this time period, going back just a few weeks, but nonetheless, so be interesting if we get some up today and tomorrow. This is going to turn bullish, and QuantBox will project it up. Okay, so that could be interesting, and that would turn this into a +1, and it would this would then turn to -3, right? And right now, it's still not favorable for bullishness, but we're in a period of time that might be changing. Okay, another point I wanted to make was oil would go up, gold would go up, and Swiss franc would go up. And here's the radical change that we had when suddenly, out of the blue, surprise to everybody, geopolitical risk. And I've trained you to be ready for Swiss franc to go up, and it did. So we should start our week by reminding ourselves things are not normal. You should not be trading your normal habits in an abnormal world. Okay. And what I wanted to do, it's funny that that's there. I'm not sure how that happened. Uh, this is the first sell zone. Okay. I don't know why I'm down there. That's weird. Um, hmm, don't know. Limit orders should have last night, if you're a bear, of course, be placed down in this area here. What you're trying to do is catch, okay, the falling 21 EMA. That's the job. So I'm short. I don't know why. That's a terrible trade. I don't know why I'm short there. Who did that? I must have I must have clicked a button or something. I don't know. But the standard operating procedure, the modus operandi, would be sell it right in here. You could use the monthly. I would use the central. You want to be in just short of the central, and it's partially the central, but it's also partially the 21 EMA. Okay, but if there's geopolitical risk, you want this down. The top of the market is monthly M3, which projects 56. Like, uh, yeah, if you're below the 21 EMA, you're bearish and aggressive. So that's just that. That's it. It's just, so I'm short at a terrible place. I don't know how I got there, but nonetheless, the logic is still the same. This should be heading down this week. This weekly target, if the central pivot does hold, then we're on our way to, let's just call it 0.5555. Okay, something like that. What? Hurrah! CAD Swissy, I would stay away from, because if there is inflation uh, on the commodity side of things, then Canada's going to benefit. So I'd be careful, but let's just do technical analysis. Let's say I know nothing. All right. Then you would sell it off that 21, like you should have here, like you should have here, like you should have here. Okay. Straight out of the training course, straight out of the book, nothing interesting about that. Right. That's all I know about that. Okay. Terrible. Terrible. Look at that. Just terrible. So this is so bearish that it's hard to even imagine a pullback, which makes it very tricky. Let me change this up. Daily confluence bearish. So the trade plan for today is sell it at 110 and take it down to 109. Basically, it's actually less than that. 108, almost 108. Wow. But Friday was a beast of a day, huh? But nonetheless, are you seeing the thread here? Swiss franc was weak because of the Swiss National Bank's policy and objectives. Then on a Saturday, Hamas attacks Israel. Sunday night, I get on the horn with the day trading group, and I'm like, I'm only interested in gold, oil, and Swiss franc. Long all three of them. It's the only thing that you should be thinking about. And yeah, these things are smoking hot. So I'm driving home the lesson so that you can repeat this over and over and over and over again in the future. And it's important because you want to be able to stay calm and stay focused in a time of duress when everybody else freaks out. Doesn't happen every day, but it happens a lot. Humans are a complicated beast. Okay. So, anyways, trying to get short this is difficult. Look at the pattern. Monthly M3, and here's our target zone. The most aggressive target for the month of October, the lowest projected low possible is 94.57, not 94.50, 94.57. We hit it precisely, did not go to the midpoint psych levels, stopped at 94.57, and then had a big up. Okay, institutional investors are using Euro Swissy, and B, I don't know what's going to happen next, because that's the predicted normal pattern. Oops, do that again. Okay, that's the pattern. It's in the book, it's in the course, it's a standard operating procedure, and well, that's that. It's happened now. Now, the rule of thumb is it could come all the way back to the central. That is true. This is not a normal market. That might happen, but I could say we could easily head down to S3 and beyond, because this is not a normal market. This is people freaking out. Okay. It's hard to talk rationally to a rooster when it got its head chopped off. Hmm? I'd say it would fall on deaf ears, but I don't know if chickens have ears. Of course they have ears. Yeah. So so I'll leave it at that because I don't want these videos to be too long. We still have geopolitical risk, but we still have long-term trends that are still okay, like that S&P 500. So really have really want it to go up, but what I want, nobody cares. Market doesn't care about me. Okay, there's nothing special about me. So I'm I got to be ready to be wrong, but so far I'm not. So have a wonderful week. I'm here every single day this time. It's like a stand-up comedian trying to get you to come back to tomorrow's show, right? Yeah, no cover charge, but a 2-drink minimum. I'll see you tomorrow. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day.